Now we will start with the another head of the income, that is income from house property, which is covered under section 22 to 27 of the Income Tax Act. So first we'll start with some basics about the house property. What is house property and what is the income from house property? So first of all, house property is, there are some points that are given in a Income Tax Act. That is, house property is any building or land appurtenant thereto. Okay, so building, any building, that it could be any compound, any house, any office building, any backyard, sorry, any house, any office, any type of building is considered here. Then land appurtenant thereto. Land appurtenant is the land that is attached to the building that you cannot remove. That means it becomes a part of the building. Okay, so in the case of like households, so land appurtenant can be in the case of houses. It could be a playground, it could be a courtyard, it could be a backyard, it could be it could be a stable for horses, it could be a shed for the cows or buffaloes. So any part, any extra land that becomes or that is attached to a part of the house is also considered in calculating the income from house property. And in the case of offices also, the land appurtenant is, if in the case of offices there are different buildings, so road connecting those buildings will also be a part of it. If there is any playground or play area for the employees, that will also become a part of it. So parking area is also a part of it. So any, you can say any land, any extra land that is attached to the building will become a part of the house property, and any income that you receive from it will also be calculated under this head. Okay, so that is house property. And second thing is that under the house property, the income that we calculate is notional income. Notional income is, that is, it is the potential capacity of the potential capacity or capability of the property, the income that it can yield. Potential capacity of yielding income. Okay. Notional income is, that is, even if you are not earning any income from that house property or from the land appurtenant thereto, but it will be considered as a notional income because we will calculate the capability of that building. That even if you are not letting out for rent, even if you are not getting any income from that property, what is the capacity that you can earn if you let it out? Okay, or what if you use it? So in that case, we calculate it notional income. So only under this head, under the head of house property, where we calculate income with notional income. That is, we calculate the capacity. It does not depend if you are actually earning it or if you are not. But if it has the capacity, then it is an income. Okay, but under all the other heads, we calculate income according to the base, we are actually earning it. Like in the case of salary, if we are actually earning salary, only then we will calculate income under the head salary. Otherwise, we are not talking about the potential of the person that he can earn that much salary, right? But in the case of house property, we see if the property has the potential, has the capacity to yield income, and according to that, we calculate its income. All right. Then there are few conditions that the SSC has to satisfy. First is that he should be the owner of the property. To calculate tax on the income from house property, the person, the SSC, should be the owner of the property. By ownership, we mean either he is the owner or deemed owner. And we have understood the meaning of the word deemed. That is, even if the person is not directly liable for that income or is not directly getting that income, but he is getting it indirectly. So he will become a deemed owner. So we will understand this definition in detail after this slide. But for now, you just have to know that he should be the owner of the property. Either he could be directly owner or deemed owner. Then it should be used, it should not, the property should not be used for business or profession. If the property is used for a business or profession, then the income that you receive from that property will be considered under the head PGBP. For calculating it under house property, it should not be used for any business or profession. It should be a personal property that you use to earn income. Okay. So these are the main points, that building and land appertaining thereto will also be taxed. The person should be the owner of the property, and the property should not be used for business or profession. And we calculate income on the notional basis, that is, we see calculate income according to the potential of the building, not just what it is yielding. Is this clear? Okay. Next is, who is deemed owner? As I told you that the person can be the owner or deemed owner. So deemed owner is covered under section 27. The definition of deemed owner is given there. Deemed owner means that the person is not legal owner but deemed to be owner. That is, even if the person is not a legal owner, the property is not under his name, but he will be considered as the owner of the property. And when that it happens in the case, first is, if the property is transferred without adequate consideration. If the SSC has transferred the property without consideration, adequate consideration, to his spouse or child, minor child, basically. So if a person, if an SSC has transferred the property in the name of a spouse or minor child, in that case, even the property is legally in the name of a spouse or the minor child, but it would be considered as the property, or the income that we will calculate from that property will be considered in the name of the SSC only. Not in the name of the spouse or not in the name of the minor child, but in the name of the SSC. Okay, but there are few exceptions, that is, if the spouse gets the property for because of the agreement to live apart. If the partner, if the spouse has an agreement that they have a divorce, or they have an agreement, they had a fight, that they will live apart, and according to that agreement, the SSC is liable to give property to the spouse. In that case, he is not deemed owner. But in other cases, when they are living together, when there is no agreement like that, then he will be the deemed owner. And in the case of minor child, if the minor child is a married daughter, in that case also, if she is the minor child is a married daughter, then it is not, then it is the property of the married daughter only, not the SSCs. But if the minor child is not a married daughter, is a son or a daughter who are not married, in that case, the SSC will become the deemed owner. Okay, and why this clause is given? Because sometimes to evade taxation, people do this, people transfer the property in the name of the spouse or the child, so that they will not have to pay the tax. So that's why the government has introduced this in the Income Tax Act, so that people cannot evade from their tax liabilities. So these are the situations where, even though the property is another person's name, but he will be considered as the deemed owner. Next is holder of an impartible estate. So if the property is under the impartible estate, is that is not legally divisible. So the property is not legally divisible. There isn't you can say there's a notice regarding this property that it cannot be divided. And if the holder of that impartible estate, the holder of that impartible property will be the deemed owner. Member of a cooperative society, company or AOP. In case, in the case when a member of a cooperative society, company or AOP receives property under house building scheme. Okay, so if the member of the cooperative society, company or AOP receives a building under house, receives a property under house building scheme, then he will be considered the deemed owner even though legally the property is under the name of the cooperative society or the company or the AOP. Okay, in the documents, the property is under the name of the society, company or AOP. But because the right to use the property is given to the member, so the member will become the deemed owner and he will have to pay the tax on that income. Alright. Next is person in possession of a property. Person in possession of a property is when a person has taken a lease. Sorry, not this one. Person in possession of a property means that person has bought the property and has the person has bought the property, taken the possession, has given the payment, taken the possession, but till now he has not been legally, that is you can say in the documents, he has not been become the owner of the property, but he is living there and he has made the payment. Then in that case, that person who is in the possession of that property will also be considered as the deemed owner. Okay, not a registered owner, but the person who has the property, who is living in that property will be considered the deemed owner. And person having right in a leased property for more than 12 years. So if a person is living in a property on, has taken a property on lease and he has been there for more than 12 years, the lease contract was for more than 12 years, that means it should be a continuous lease contract. In that case also, that person will become the deemed owner, that is whatever income he will be receiving from that property will be taxed on that person only. He will be taxed, the person who has taken the lease. Okay. So this is the definition of deemed owner. Is this clear? Okay. Next is there's a concept in the case of house property, that is composite rent. Composite rent is that rent on various facilities provided with house. So in case when a person takes a property on rent, so suppose the property includes like air conditioning, the property includes lift services, guard services, water facilities. So in that case, he is not just getting the house, he is getting all other facilities that even if the owner of that property has not provided, he would have to pay it separately. So in that case, that is known as composite rent, where the rent includes the cost of all these extra facilities that he received with the house. Okay. So in that case, if the person is receiving composite rent, the owner is receiving composite rent, in that case, we divide this rent into two parts. The part of rent which is related to house, that would be considered under income from house property. The part of rent which is for the various facilities that are provided, that part of the rent will be considered under income from other sources. Okay, so this is why we have to study composite rent, because when the rent is provided, when the house is provided with attached to various facilities or services, in that case, the owner receiving the composite rent has to divide the rent. So rent related to only the house, the building, will be house property income. Rent related to various other facilities or services will become income from other sources. Okay. And if it is not separable, if they cannot separate, not separable, then in that case, entire income will become either from PGBP or other sources as the case may be. So if it is not separable, then it would be either PGBP or other sources. There is another case if the services that are provided are like higher charges of machinery. So like if not in the case of house, but if the property is provided to a business owner or to a manufacturer basically, so in that case the property is attached with the machinery. Okay, and the rent includes the higher charges of the machinery. In that case again we will divide the rent. So rent for house or the building will be the house property income, and the rent for the machinery or the facility that is provided will be either PGBP because it is for business purposes or for other sources. And again in this case also, if it is not separable, income will be under entire income. Even the house income will be either in PGBP or other sources. Okay, so first we have to see if it is separable or not. If it is separable, then we divide it accordingly, the house property or other sources or PGBP, whatever the case is. And if it is not separable, then we conclude the entire income as PGBP or other sources. Is this clear? All right. Now there are certain exceptions where the income that you are receiving, even it is from the property, it will not be considered income from house property. And what are these cases? If the income is from a farmhouse, that is the building is in the vicinity of agricultural land, and when we did agricultural income, I told you this point that even if it is a farmhouse which is in the vicinity of agricultural land, it would be considered as an agricultural income. So this is an agricultural income which is exempt from taxation, right? So this is not considered house property income. Property held for charitable or religious purposes will be exempt, you can say, because it was under the in the case of exemptions there it was there that if a property is for charitable or religious purposes and whatever the income is earned will be exempt. Property used for own business or profession, as I told in the starting that if the property should not be for business or profession, if it is for business or profession then it is under PGBP. Okay, so the property should not be, and if it is should not be for the use of business or profession to be calculated under house property income. If the person has, the SSC has only one self-occupied house. So if a person has one house and that house is self-occupied, in that case we do not calculate tax on that income, because as I told you that in the case of house property we calculate tax on notional income, right? That we see the capacity of that property. But in the case of one house property only, which is self-occupied, we do not calculate that, or we can say it is exempt. And from financial year 2020-21, the exemption was limited to extended to two house properties. So even if the person has two house properties, both are self-occupied, then also he do not have to calculate any house property income. Okay. Property of registered trade union or local authority is also exempt. One palace of ex-ruler. So if an ex-ruler has only one palace, then it is not calculated. But if he has more than one palace, then he will have to calculate house property income. Property for political party, property used for scientific research. In all these cases, property income is not considered under the head house property. Is this clear? Okay. Now these were some concepts. Now what is income from house property? How do you calculate income? So first of all, we calculate gross annual value of the property, or we can say GAV. There is also a method that we'll study in detail how we calculate gross annual value or GAV of the property. Then from that GAV we deduct municipal taxes that are paid. Okay, and then we get net annual value that is NAV of the property, and on this net annual value we have deduction similar to what we had in the case of salaries, income from salaries. We have separate deductions. So similar to income from salary, we have in the case of house property deductions under section 24. Now can you guys tell me what section was in the case of salary? Under which section we had deductions under the head salary? Come on guys. It was section 16, correct. Then under deductions under section 24 we have two deductions, that is standard deduction and interest on borrowed capital. After these deductions, we get income from house property, or you can say taxable house property income. Okay, so these are the steps that we have to do to calculate income from house property. First, we have to calculate the gross annual value. Then if we have paid any municipal taxes, then we deduct it. We get net annual value, and from that net annual value we have to deduct deductions under section 24, which are two deductions. One is standard deduction and interest on borrowed capital. Then we get income from house property, which is used for calculating income tax. Okay, so now we will discuss each step, what is the value calculated in each step in detail. So first, let's start with gross annual value. That how we calculate gross annual value. So step 1 in this case is that there are we have to calculate expected rent. As I told you that income from house property is on notional basis. So we calculate expected rent. What is the potential of the property, or what is the rent that a property can earn. Okay, so expected rent, which is calculated on the basis of 3 factors. What are these 3 factors? First is municipal value. What is municipal value? Municipal value is whenever the concerned municipality of that area calculates the value of the property to charge tax, because the municipal charge municipal taxes for a property. So whenever they calculate a value for a property in their particular area, that value is known as municipal value. Second is fair rent of the property. Fair rent of property is nothing but when we compare the property that are in the surrounding areas and we see what is the rent of a particular let's say piece of house in that area, that is fair rent of the property. Third is standard rent under Rent Control Act. So whatever the rent is given for a particular house property in a particular area, that rent is considered. Now what we have to do is, in the step 1, to calculate expected rent, we have 3 values. From these 3 values, first 2 values, municipal value and fair rent, we take the maximum from these first 2 values. The maximum value will be considered. Then from this maximum value, we compare it with the standard rent, and whatever is the minimum will be our expected rent. So this is a two sub step that we have to consider in calculating step 1, expected rent. First we see municipal value and fair rent. Whatever the maximum value is there in both the cases will be taken, and that maximum value is then compared with the standard rent, and then we take the minimum of those, which will become our expected rent. So this is very important. Municipal and fair rent maximum, whatever the value comes, then we compare it with the standard rent, and the minimum value from these will be considered as the expected rent. Okay. Second step is we calculate rent actually received or receivable minus unrealized rent. So in second step, we calculate the rent that the SSC is actually receiving or will receive, deducted with the unrealized rent that he should have received it, but the person to whom he had let out the property fails to pay the rent. So that is unrealized rent. Then in step 3, step 3 is 1 or 2, whichever is higher, will be considered. Okay. Then step 4 is whatever the value comes in step 3 minus loss due to vacancy. So if the property is vacant for a few part of the year, then we deduct it with that loss. And finally, in step 5, that is 3 minus 4, we get gross annual value, GAV. Okay. And if we do not have any loss, in step 4, if we do not have any loss, then step 3 will become our GAV. Is this clear? This is very important to understand how we calculate GAV, because many times a question is asked on calculating GAV because on the basis of these 3 values only. So you need to understand how to calculate GAV. Is this clear or not? Okay. So let's do this question. Now you have to calculate GAV in each case. So start with the first case. Now tell me what would be the GAV in this case. Come on guys. What is GAV for first case? So for the first case, the step 1 to calculating GAV is that we compare municipal value, fair rent and standard rent. Right? Now in the case of municipal value and fair rent, we take the maximum. Okay. So maximum of 2 lakh and 2 lakh 40 is 2 lakh 40. Then we compare it with the standard rent. 0 is standard rent. So in this case, in comparing these, the minimum value will be considered. So that means minimum is 0. And then in step 2, we see what is the actual rent. Actual rent is 1 lakh 80. And in step 3, it was compare first and second. Whichever is higher will be your gross annual value. So in this case, sorry, one thing that I forgot to tell you, that if standard if standard rent is not applicable in the case, then we do not consider standard rent. We only take municipal value and fair rent. That means we do not consider the second step. So let's say when standard rent is not given, this is not given, then only this value is taken as step 1 or expected rent. That would be considered if standard rent is not given. If standard rent is given, then after this step only we will calculate standard expected rent. So in this first case, you can see standard rent is not given. So first step is municipal value and fair rent, whichever is higher, that is 2,40,000. Then step second, actual rent. Step third, comparing first and second, whichever is higher will be considered as gross annual value. So 2,40,000 will be gross annual value in the first case. Is this clear? All right. Then in second case, so let me just do it in detail like this. Step 1, step 2, then step 3. That is GAV, because we do not have loss due to vacancy. So step 3 will become our GAV. So in the first case, in step 1 our expected rent was 2,40,000. In step 2 it was 1,80,000. So our GAV is higher of both, which is 2,40,000. Now in the second case, okay guys, now tell me what is the value in step 1. What will be the value in step 1? What is expected rent in step 1 in this second case? Right, Sabiha? So it is, no. Sabiha, first is that we check the maximum of these. So maximum is 3 lakh. Then we compare it with the standard rent, because in this question standard rent is given. Then when we'll compare it with standard rent, we take the minimum. Okay, so 3 lakh and 2 lakh 40, which is minimum 2 lakh 40. So step 1, our expected rent in second case will be 2 lakh 40,000. Is this clear? That why it is 2 lakh 40? Then step 2, actual rent is 3 lakh 60. So our GAV step 3 is higher of 1 or 2. So our GAV will be 3 lakh 60,000. Is this clear? Yes or no? Okay. Now in third case, what would be our expected rent? Step 1 is expected rent. So what is our expected rent in third case? No, Sabiha, it is not 5 lakh. Sabiha, remember the steps. First, maximum, then minimum. So first is maximum of these. Maximum is 4 lakh. Then this 4 lakh is compared with standard rent and we take the minimum of this. So minimum will be our expected rent, which is 4 lakh. So remember the steps, maximum and minimum will be, after that we get expected rent. Okay, first maximum, then minimum value. So first maximum 3 lakh 60, 4 lakh. 4 lakh is our maximum value. Then this 4 lakh is compared with standard rent, that is 5 lakh, and we take the minimum value. Alright. Then step 2 is actual rent received, which is 4 lakh 80,000, and step 3 is higher of 1 or 2. Okay. So our GAV will be 4 lakh 80,000. Is this clear? Now in the fourth case, what would be our expected rent? What would be our step 1 value? So it would be first, as I told you, maximum. So in this case, both is equal, both are equal. So 4 lakh 20 will be our maximum value. Then we compare it with standard rent. So minimum, that means our expected rent is 3 lakh. Correct, Sabiha? Actual rent is 3 lakh 60. So how much is our GAV in this case? It would be 60,000. Very good. Now, in case 5, what is our expected rent? Now again in this case, as similar to the first one, we do not have standard rent. So that means only we will take the step of maximum value. So municipal value and fair rent, the maximum is 5 lakh. So that would be our expected rent. Then actual rent, and when we'll compare these, GAV will become 5 lakh 40,000. And in the last step, again when we'll compare 4 lakh 50 and 5 lakh, maximum is 5 lakh. Then 5 lakh and 4 lakh 80. So minimum is 4 lakh 80,000 will be our expected rent. Actual is 4 lakh 20,000. So our GAV is higher of first and second, which is 4 lakh 80,000. So this is how we calculate GAV in different cases. Is this clear to you? Now net annual value. As we discussed earlier, that net annual value is calculated when we get GAV, we deduct municipal taxes paid from GAV and we get net annual value, that is NAV. Now there are few conditions where only in the case when municipal taxes are paid. There are few cases when we deduct municipal taxes if the property was let out for whole or part of the previous year. So if the SSC has let out the property for part of previous year and he had paid the municipal taxes, then only he can claim the deduction of paying the municipal taxes. Second condition is that the taxes were borne by landlord. That is, only the landlord has, the owner of the building or the property has paid the municipal taxes. If the tenant has paid the municipal taxes on behalf of the landlord, then he cannot claim the deduction. That means the burden of paying the taxes were on the landlord and being paid by the landlord. And the third condition is that it should be paid during previous year. Okay, so if he had paid the municipal taxes in previous year, paid by the landlord, and the property was let out for whole or part of the year, only in these three conditions can the SSC claim the deduction of municipal taxes from gross annual value, and then we will get net annual value. Okay, so basically to deduct municipal taxes from GAV, the person, the SSC should follow these three conditions. If he has satisfied these three conditions, only then he can deduct municipal taxes. Otherwise, whatever our gross annual value was will become our NAV. Is this clear? Okay. Now, the next step was deductions under section 24, and as I told you that we have two deductions. First is standard deduction, or we can say it is section 24 subsection A. Okay, standard deduction says that the person can claim 30% of NAV as deduction if he has paid charges for repairs and collection of rent for the property. If the person has paid charges for repairs and collection of rent for the property, in that case, the person can claim standard deduction, that is 30% of NAV will be reduced for standard deduction. Second deduction is interest on borrowed capital, which is section 24 subsection B. Okay, interest on borrowed capital says that the person can claim deduction on the interest that he has taken on the loan that he has taken for the property. Okay, and it should be on accrual basis, that is whenever it is accrued. If the capital borrowed for purchase, construction repairs, renewals, or reconstruction of the property. So if the capital is borrowed for the following purposes, that is purchase, construction, repairs, renewal or reconstruction of the property, and he has to pay interest on that borrowed capital, then he can claim deduction. Alright, now there are few conditions in which he can claim deduction, and this can be divided into three parts. First, if the property is let out property. So if the interest on borrow, if the person has borrowed capital for a property which is let out and he has taken the loan for either purchase, construction, repairs, renewals, in that case he can claim 100% deduction of the interest that he had to pay. Okay. Second case is if the property was self-occupied, and as I told you earlier, that if the property is self-occupied, in this case, earlier only for the one property it was allowed, now it is allowed for two house properties. Okay. And he has taken the loan, first purpose is for acquisition or construction. So for the house property that is self-occupied, we have divided the borrowed capital, the purpose of the borrowed capital into two parts, that is acquisition or construction. Second is repairs, renewals or reconstruction. Okay. Now in the first part, if the loan is taken, the capital is borrowed for acquisition or construction and it is up to 2 lakhs taken on or after 1st April 1999, and the acquisition or after taking the borrowed capital, the acquisition or construction was completed within 5 years. Okay. In these cases, the SSA can claim a deduction of rupees 30,000 from the interest. Alright. And in the case, if the loan was taken for repairs, reconstruction, wait. If the borrowed capital was borrowed for on or after 1 April 1999 and the acquisition was completed within 5 years, then he can claim the deduction up to rupees 2 lakh on the interest, not 30,000. The claim interest can be deducted for 2 lakhs. And in the case, if it is for repairs, renewals and reconstruction, then he can claim deduction up to rupees 30,000. In this case, it is up to 30,000. Okay, in all the other cases, if the loan was taken before 1st April 1999 or if the construction was not completed within 5 years, then also he can claim a deduction only up to 30,000 if these conditions are not satisfied. Then 30,000 if these conditions are satisfied, that is that loan was the capital was borrowed on or after 1st April 1999 and completed within 5 years, then he can claim up to 2 lakhs. If these conditions are not satisfied, then he can claim only up to 30,000. Or the loan was taken even after on or after 1st April, but if it was for repairs, renewals and reconstruction, again he can only claim 30,000. All right. And the third case is pre-construction period. If the capital was borrowed for pre-construction period, then he can claim deduction, and the borrowed capital was for acquisition or construction purposes. That is only for these purposes. If it was for repairs, renewals, reconstruction, then we do not claim the deduction. If it was for pre-construction period, that is before construction started, and it was for acquisition or construction of the property, in that case also he can claim deductions in 100% deduction in 5 equal installments. Okay, or you can say 1/5 every year for 5 consecutive years. In 5 equal installments or 1/5 every year for 5 consecutive years, the person can claim the deduction on interest on borrowed capital. So in all these 3 cases, the person can claim reduction. In lettered property, 100% reduction is allowed. In case of self-occupied capital borrowed for acquisition or construction on or after April 1999 and construction completed within 5 years, he can claim reduction up to 2 lakhs. And in all the other cases, simply in all other cases, repairs, renewals, reconstruction, apart from these conditions, the person can claim reduction up to rupees 30,000 only. And if the borrowed capital was for pre-construction period, capital was borrowed for acquisition or construction purposes, then deduction can be claimed for 5 equal installments. Is this clear? Okay. Now, annual value of self-occupied house, as I told you, if there is a self-occupied house, earlier there used to be only for one, now it is for 2 houses from assessment year 2021. Okay, in that case, annual value, that is the gross annual value will be nil. We take gross annual value or net annual value for self-occupied house nil. And from this nil value, the person can claim deduction of interest on borrowed capital. He is not eligible for standard deduction and for 2 self-occupied houses. So annual value is nil. Deduction is available on interest on borrowed capital only, no standard deduction, and can be claimed for 2 self-occupied houses. Okay, that means the deduction on interest on borrowed capital, it is a self-occupied house, and as I told you, in self-occupied house we had 2 purposes, acquisition and construction and renewals and repairs. For acquisition and construction 2 lakhs was the limit, and for other purposes it was 30,000. So that is the deduction in the case of annual value of self-occupied house, where both 2 houses it is eligible, 2 houses are self-occupied. Then annual value of partly self-occupied house. Partly self-occupied, that means it was partly part of the house was self-occupied, part of the house is let out. As you guys might have seen in most cases that people live build many floors of in the house, and they live on 1 or 2 floors, then they let out to the tenants or the other floors. Okay, so in that case, where the house has 2 separate units, one is self-occupied and one is let out. So in that case, first we distribute them in 2 parts, self-occupied and let out, and accordingly we calculate the value. For self-occupied value, annual value is nil and deduction is available for interest on borrowed capital only. And in the case of let out, as we calculate the value, the net annual value that we have done, then we calculate deduction and accordingly we get the taxable value of the house. Okay. And in case if the house was self-occupied for part of the year only, for part of the year, then whole house will be assumed as let out, and then we calculate the value. So that means this method is applicable only if the house was self-occupied for full year, and if it is for part year, then we calculate it as assume as let out only. Okay, and accordingly we calculate the value, we calculate GAV, we calculate deduct municipal taxes, we calculate net annual value, we deduct deductions under section 24 and then we get the income from house property. Is this clear? Okay, then let's do some questions and then it will finish our income from house property. Okay, now tell me what is the gross annual value of the house property. You are given municipal value, fair rent, standard rent and actual rent. We did this type of question. Now what is the, tell me, what will be the gross annual value in this case? Come on guys. Gross annual value will be maximum of municipal and fair rent. So maximum is 5 lakh. Then we compare it with standard rent and we take the minimum. Minimum is 4 lakh 80,000. Then we compare it with the actual rent and higher of these will be taken as the GAV, which will be 4 lakh 80,000. So our gross annual value is 4 lakh 80,000. So answer is A. Again, similarly, you have to calculate the gross annual value. So what is the answer in this case? Again, first maximum of both, which is 68,000. Then we compare it with standard rent minimum, which is 62,000. Then we compare it with actual rent, the higher value, which is 65,000. This is our gross annual value. So answer is C. Okay. Next, A has two house properties. Both are self-occupied. The annual value of, so what is the correct answer? Answer is A, correct, because both houses, the annual value of both houses shall be nil because in case of two self-occupied house property, we take annual value nil. An SSC has borrowed money for purchase of a house and interest is payable outside India. The interest shall. So if the property is purchased and he is paying interest outside India, will that interest be allowed as deduction? So in this case, interest will be allowed as deduction if the tax is deducted at source. That means if there is TDS, tax is deducted at source, only then in that case, because tax is collected here, he will be allowed as allowed the deduction. If it is not, then he will not get deduction under section 24. Okay. Next, you have to compute the steps for calculating gross annual value from house property. So what are the steps? First, we calculate expected rent. So third is, this is our first step. Then we calculate rent actually received or receivable. That is our second step. Then if there is any loss due to vacancy, we deduct it. Then we calculate value which is higher in the first and second step. So fourth is our third step. Then we calculate or deduct loss due to vacancy and we get gross annual value. So these are the steps. So answer is A. Correct, Sabia. So this finishes our house property, and now we'll start with PGBP.